investment bankers. We always follow these investment bankers. We know what they have done to the world in 2008-9. All the derivative trading, all the investment banking firms which went out of business was because of their excessive greed. Now here you have investment bankers who are appointed by the company, they are paid by the company, they are agents of the company to sell the stock to get the maximum price for the company because they are paid by the company. We as investors, what we do is, we only listen to those people, research report, we read and go to their analyst meet. We only ask them, what do you feel about the issue? How can they say something wrong about the issue? Because they are paid by the issue and their payment is based on how much price they will get for the company. So, they are not investment advisors, but investors consider them as investor advisors. But actually, they are nothing but selling agents for the company. Even when Reliance Power, when it became the mother of all issues, when it became oversubscribed, you had all the merchant bankers coming on TV and claiming that what a great job they had done, what a great job they had done, that they had collected so much of resources for the company. And that was just short-lived, because on listing, when the when the gains were not there, when people started making losses, none of them ultimately came on the TVs. I don't know how many of you remember the Morgan Stanley close-ended fund. Now normally, what is a close-ended fund? A company, Morgan Stanley, came out with a close-ended fund. So they collect money from everyone. There is a particular date that all the money will be collected and then they would be invested. And the expenses of doing all that issue would be deducted from the fund which is collected. So if 100 crores is collected, there would be an expense of maybe 2% or 3%. So the NAV of that for 10 rupee would be always about 950 or 960 or 970. But you had a grey market premium which was manipulated, was about 17 to 18 rupees. And a close-ended fund, people were so irrational that people bought Morgan Stanley close-ended mutual fund at a premium in the grey market, and ultimately they lost all the money. A lot of people who were there, who had manipulated, they lost their jobs also. But what does a Morgan Stanley close-ended fund show us? It only shows us the stupidity and the foolhardiness of the investors themselves, because no one can fool you unless you agree to be fooled. And this was a classic case. Today what happens is, today we don't have the controller of capital issues. So every IPO which comes to the market is market priced. Now, how does this market pricing come? The sentiment decides the price. Otherwise, you would be having issues coming in bear markets as well as bull markets. But as I explained to you earlier, when the sentiment is high, that is the time they think these people are able to get a good price for the market price. That is the reason IPOs only come in bull markets. And when they are market price, can we really say that I want to get into IPO when there are over 6,000 stocks listed on the market? Every stock has a potential. Then why should we give special treatment to an IPO? Especially when we know that those people are trying to sell their stocks to you because they believe that you are paying a better price to them than what the fundamentals of that company justify. That's why you have always IPOs of hot sectors in the market. Every year, in every bull phase, you have different types of hot sectors coming. You had the technology sector which was hot. You had the power sector which was hot. Now you have the real estate which was hot and which is still hot. Infrastructure is there. The next sector I believe would be the gas sector. So you are going to have IPOs coming in all those sectors. And if they are going to be market price, then I think what your idea should be, is there any neglected stock in the market which I can buy, which is available at a good price? That is value investing. Now, most of the investors even understand what I am talking about. But what they say is, I know, it's fine, I will sell on listing. The problem is that everyone is thinking the same thing. The same thing happened in Reliance Power. You talk to anybody, we know it is overpriced, but yes, on listing I will be the first one to sell. When everyone was thinking, everyone they came to sell on that first day of listing, and the market prices just crashed. So it is the greed of the investors that knowing that it is a dangerous stock, let me get into it. Secondly, it was again the overconfidence that I can control the markets, I can control my decision making. Nobody can control the markets, because on the same day of the listing, where everyone came to sell together, there were no actually buyers. And we have to understand one thing, that tomorrow we may believe that we want to make money over there in a particular stock, but who will buy that stock? Because you cannot go on buying a stock at any price, because other fools may not buy it. But most of the time, investing decisions are based on the greater fool theory. Everyone feels that I am smart, so I am buying just now, I will find another greater fool who will buy it from me. But actually in real world, it doesn't happen, because all those greater fools all come to sell together. Now this was quoted in yesterday's Business Line. Microsec Financial retained portion subscribed 11 times. Eros International Media 26 times. Career Point Infosystem 32 times. Met with runaway retail response. This is vaguely reminiscent of a frenzied market of 2007, when IPO allotments were seen as prizes to be secured, and every IPO was thought to be a surefire listing bet. Now, we don't know the management of any of these companies. We don't know business model of any of these companies, and this is the first sign that things are becoming dangerous. Long-term underperformance. Now, IPOs only come when the demand is strong, and when the demand is strong, that means there are higher prices, and when there are higher prices, that means there are lower returns. I think you don't require rocket science to understand this. So whenever you buy an IPO, your returns have to suffer in the long run, because value investing is all about buying something at the right price and holding on to it for a longer period of time. So most of these IPOs over a period of time, they think ultimately harm your returns. If you are able to sell on listing gains, maybe in one or two things you may be lucky, but I am sure that once it becomes a habit, the market knows that it has to reward only long-term investors, it will never reward the short-term investor. In markets, you may hear people talking about, I made so much money, I made so much money, because it's human tendency to talk about their successes and never talk about failures. So when you are in a marketplace, when you hear all these talks from people, you feel that you are the fool, you are the one who are left out, and you start chasing a stock or an fancy which is in the market, ultimately to become a lot poorer. This is again what Business Line said. While the Sensex has almost made it back to its January 2008 heights, nearly 40% of the 2007 IPO stocks are still in the red for the origin investors, with some even trading at less than half their offer price. I had done some homework of the 1995-97 IPO boom which was there after the liberalization. There are about 60% of the companies, they have vanished. We don't know what is there. Of course, that time SEBI was not very strong and all, that's why every Tom, Dick and Harry could get into the market. 60% of the companies had just vanished. I'm not talking about that they're saying the prices were below issue price, but they had just vanished into the thin air. Because that time with even 3 crores, you could come out with a public issue, and we had a host of finance companies coming out with such public issues. Now this is 25th September Economic Times. A price performance study by CARE Research, a unit of rating company CARE, shows that 62% of the 116 IPOs between August 2007 and August are trading lower than the sale price. Now, that doesn't mean that the 38% people are making profits, because consider the opportunity lost in buying the right stocks because your money was blocked up into that. Consider the inflation rate, consider the interest factor. So mostly all of these IPOs, since they were in the hot market period, they think people have been losing money in that. There could be certain stray IPOs where people would have made money, but not very much. Again, this was yesterday. India's biggest share sale by Reliance Power in January 2008 has left investors poorer by 42%. Now, adjusted for bonus. So was the case with India's biggest real estate developer DLFS, whose shares have fallen 30%. Future Capital Holdings is down to 2/3 from a sale price of 765. Now, all these were big names, big brand names in the market. But they knew that the investors are rational. Let's sell them the shares at fancy prices. And if the investors have lost, I think they are there to be blamed, because a company is always going to benefit out of your irrationality. Well, if suppose this is the problem, then can there be an underpriced IPO? Today we are in a market driven system. This was an IPO which came in 1998. It came with a convertible debenture, Noida Toll Bridge. The shares were converted in 2002, this thing at 10 rupees. Investors have been holding on to this. 2006, it came out with a GDR, price at 36 rupees, because 2006 and people were willing to give the money. In 2006-07, the highest price of this company was somewhere around 89 and the lowest was something around 22. Today, the company has passed through all the turbulent times. The company has started making profits. The company is in a positive zone. After 12 years of hard work, the company would be now rewarding its shareholders. Now today this stock is available at 35 rupees. Now why should you choose an IPO when you know that an old IPO, now because it is forgotten, it is in its cold period, it's not in its hot period, and investors have been tired waiting on it. And when they are tired and when they are selling, you are getting this opportunity, because now it has become a value. You cannot get these values every time in life, but this is to show you how irrational the markets are, how irrational the investors are, that even at an index of 20,000, they throw up such opportunities. We over here have to be planning that don't get into the markets by looking at the indices, because indices may seem cheap or expensive. 20,000 index means what? But as I have always been telling, 30 shares make up for the BSE Sensex, 50 shares make up for the Nifty. Now, is that the right sample for us to judge 6,000 stocks listed in the markets? Noida Toll Bridge is not in an index or anything, but it's one of the best value buys you can really have today. Thank you. I'll take any questions anybody has.